How many want to know more about what the legislation's doing with the IRAs? How about an update on the war on self-directed IRAs that's going on with the government right now? Is real estate banned from your IRAs, or has that gone away permanently? It's not going to sneak back. Is there a limit? Is there a cap? Is it still possible to sneak back in? So, if you've ever been thinking about any of these, we hope to really get all this information out of John tonight. So, rather than what the government disallows, they also have RIA discounts. So let me introduce to you trained over 50,000 real estate investors and small business entrepreneurs across all the U.S. and Central America, focusing on investing in real estate, notes, precious metals, private equity, and various other alternative assets. None other than John Bowens himself from Equity Trust.
Awesome.
Welcome.
Thank you. Thank you, Anna. I appreciate it. Thank you very much. Awesome. Well, welcome, everybody. Really excited to be here. Again, John Bowens. I am with Equity Trust Company. I'm our head of education. For those of you who aren't familiar with Equity Trust and what we do, we are what is called a directed IRA custodian. And so what that means is you have the ability to take control of your retirement plan. You have the ability to buy and sell real estate. And I will talk through over the next 90 minutes how you can effectively buy rental properties with your self-directed IRA, how you can do joint ventures. So even if you don't have hundreds of thousands of dollars in a retirement plan, you're going to learn how through real estate joint ventures, you can make a meaningful tax-free profit in your self-directed retirement accounts. Additionally, I'll also talk about private lending this evening. Now, I'm a real estate investor, so I am here wearing my Equity Trust cap. And again, we're a directed IRA custodian, which means you provide the direction to us to facilitate the real estate transactions that you deem as a good fit and a right fit for your own portfolio. Now, what most people are familiar with is a managed IRA. So a managed IRA would be where you're working with a financial advisor or a wealth manager to make the decisions with respect to your retirement savings, which is absolutely acceptable. I know the gentleman from LPL, Mr. Wilcox, had come up here and talked a little bit about diversification. I think that's a great thing to mention at the very beginning of this program, is diversifying your portfolio. You know, in fact, some people, they'll say, well, John, aren't financial advisors and wealth managers sort of your competition or your enemy? And some people may think that, but contrary to that belief, it's not necessarily the case. In fact, we have great relationships at Equity Trust with financial advisors and people that work in managed money, because we have a lot of folks that want to take a percentage of their retirement portfolio, peel it off, and buy some real estate, or make a loan secured by property, or invest in a real estate joint venture, or real estate partnership, or buy a land contract, or buy a note. And so we actually work with over 13,000 financial advisors across the country, because they're actually referring their clients to us that want to diversify into hard real estate in addition to what they're doing in the stock market. So I mentioned that at the very beginning of the program because I'm not biased to just holding hard assets like real estate in a retirement plan. I understand that for some folks, there's a strategy to diversify into the traditional financial markets as well as to diversify into real estate. Now, I'm a real estate investor. My wife and I own real estate in and outside of our retirement plans, our self-directed IRAs. We also are private lenders, so we make loans secured by real estate to local real estate flippers. Now, I should mention that as a quick disclaimer here, that me mentioning that I make private loans to individual investors for their fix and flip transactions isn't a welcoming invitation to stop me after the event is over, which always seems to happen, of all places, where do you think? In the restroom. And so again, not a welcoming invitation. By the way, I should mention another disclaimer, that I'm not here to give tax, legal, or financial advice. I'll have a slide on that coming up here shortly. And also, I should mention that I don't have many jokes. The ones I do have, as you can tell already, are very dry. I spend a lot of my time, yes, keeping an eye on government regulation, keeping an eye on tax law changes, reading the tax code. So if I tell a very dry joke, just bear with me, laugh at me, and we'll carry on, okay? But I will say I'm going to make this a very content-rich, very educational program for everybody this evening. Most importantly, I want to share with you the real how-to application to invest in real estate with a self-directed IRA through rentals, joint ventures, and private lending. Who has, by a show of hands, been to a self-directed IRA workshop or even just like a 20, 30-minute presentation? Okay, quite a few of us. What I have learned over the last, I've been in this business for 15 years, that is self-directed IRAs. I've been around real estate for 20 years. And what I have found in the self-directed IRA industry is there's a lot of information out there, I think a lot of hype, a lot of what you can do, but there's not a lot of how-to application. And so my goal this evening is to actually show you some real transactions that are working within self-directed IRA investors' accounts, including some of my own transactions, and really start to give you guys a blueprint and a roadmap to effectively do this, whether you're somebody that has no retirement plan at all right now, or if you're somebody that's got thousands of dollars in retirement funds. Someone mentioned before, they're sitting on a bunch of dry powder looking for a place to deploy that capital. Quick fact, there's over $23 trillion in IRAs, 401ks, and other retirement plans. So do you think there's a lot of dry powder sitting on the sidelines in self-directed IRAs? I know for a fact there is. Why? Because under custody administration, our organization has over $33 billion in assets, and we have over 100,000 customers. There is a lot of dry powder out there. Who is looking for potential joint venture relationships, private lenders? Who's looking for private money? Self-directed IRAs can be a great resource for that. I know investors that are funding a majority of their real estate investment portfolio, whether fix and flip transactions or buy and holds, some using the BRRRR method, all through private money through self-directed IRA investors. And so I'm going to give you the roadmap and the blueprint and the checklist this evening so that if you want to go out and also work with other real estate investors and use their self-directed IRAs to fund your transactions, I'm going to be able to give you some pointers and some tools on that. Okay, so the self-directed IRA, we're going to talk about the difference between a traditional IRA, a Roth IRA, and a solo 401k. Who's heard of a self-directed solo 401k before? Did some of you come to today's session to learn about a self-directed solo 401k? Anyone? I just want to know how much time I need to spend this evening on that topic. Okay, I know I got one person. Some of you may want to take advantage of that type of instrument. Some of you may not, and we'll work through that this evening. But ultimately, the self-directed IRA, the self-directed 401k, the Roth IRA, it's just a tool. It's a tool afforded to us by the federal government that allows us to invest beyond the traditional financial markets, allows us to invest in assets like real estate. And these account types carry what is called tax-exempt status. So let me make it real simple for everyone. A lot of people are familiar with investing in the traditional financial markets, that being stocks, mutual funds, ETFs, right? When your IRA or your 401k or your 403b or your 457 or your thrift savings plan, when it's invested in a mutual fund, let's say for example, because most people are limited to only doing what with their 401ks? Investing in mutual funds. Some people are lucky enough to be able to self-direct into stocks, but that's pretty rare. Typically you're limited to only mutual funds. And you would have a dividend payment. Think of that dividend income like rental income if you own a rental property in your retirement plan. So you have dividend income coming into your retirement plan. You don't pay taxes on that dividend income. It's tax exempt. And then if you sell that mutual fund and you achieve a capital gain, so you sold it for more than you bought it for, that capital gain is also not exposed to taxation. So as long as you're following all the rules, no taxes. Nowhere on your tax return is it going to ask you for how much money you made in your retirement plan, how much money you made in your IRA or 401k with respect to dividend income or the sale of a stock or mutual fund. What you're going to learn is when you buy and sell real estate, whether it's a fix and flip transaction or it's a buy and hold rental property, you don't have ordinary income tax and you don't have long-term capital gains tax, providing you follow all of the rules and the procedures. There are some limitations here, and we will share that with you so you understand the do's and don'ts of using a self-directed IRA. If I make a loan secured by real estate, so for example, in 4 days from now, I'm going to close on a private loan. It's a fix and flip transaction. I'm from Cleveland, Ohio, by the way, western suburb of Cleveland. So I have a fix and flip transaction. It's going to be a private loan to this investor. I'm going to charge 8% interest. Fix and flip should conclude in under 6 months. It's a $100,000 private loan. If I charge 8%, that's $8,000, right? I make $8,000 in profit on that $100,000 loan for my IRA. Now, interest income is subject to what tax rate? Does anyone know? Interest income. Ordinary income tax rate. My effective tax rate. So at about a 25% effective tax rate, state and federal, 25% of $8,000 is how much? $2,000? So I don't make $8,000 in profit, I make $6,000 in profit after I factor in taxes, right? If I do that same investment, which I intend on doing with my self-directed IRA, I make $8,000 in profit, and I keep 100% of that profit. And by the way, I'm going to do it with my Roth account, which means I will never pay a dime of tax ever again the rest of my life, so as long as I do everything properly and I follow all of the rules. 0% tax. So this is what I call compounding interest in the absence of taxation. That's something to write down. I know it's a little bit of a mouthful. Compounding interest in the absence of taxation. I'll actually share a slide with you to numerically represent this for those of you that are a little bit more analytical, trying to wrap your head around the difference between a Roth account and a tax-deferred traditional account. All right, so we'll get there. Compounding interest in the absence of taxation. So if I can eliminate the variable of taxation, then what that means is I'm increasing my annual return on investment. If I increase my annual return on investment, then I can ultimately get to my retirement goals and my financial goals in a shorter period of time. So I'm sure everyone here wants to try to figure out how to get to our financial goals in the shortest period of time possible, right? A self-directed IRA can help you get there. Now, I'm not saying it's the absolute end-all be-all in the real estate business. My wife and I own rentals inside and outside of our self-directed retirement plans. We do private lending inside and outside of our self-directed retirement plans. And the reason why I say this at the very beginning is just so you understand that I'm not coming from the position of take every real estate deal you do and do it in your self-directed retirement plan. Some of you, especially for those of you that are a little bit younger, you're trying to build a real estate business, right? Correct me if I'm wrong. Trying to build a real estate business. So you're probably going to do a lot more deals outside of your IRA than inside of your IRA. But imagine if you're 25, 30, 35 years old and you start putting money in a Roth account and you do one deal a year. I'm going to show you some examples in a little bit. What is that going to end up looking like 25, 30 years from now? $1 million, $1.5 million, $2 million? We start applying compounding interest and those numbers really start to magnify. So that's what I'm hopeful for many of you. You'll start to look at retirement planning with respect to investing in real estate through a little bit different lens. Now, to illustrate this from a financial equation perspective, compounding interest in the absence of taxation. We're eliminating the variable of taxes. We're investing in income-producing real estate investments. Can you invest beyond real estate? Can you invest in gold and silver with your self-directed IRA? You absolutely can. We have over $1 billion in custodied physical metals in retirement plans, in addition to real estate, private equity, cryptocurrency, various other private securities. You can custody just about any type of asset in a retirement plan. There's very, very few governmental limitations. And let me talk, as I mentioned, that governmental limitation. Anna mentioned this before. There was, do you guys remember the Build Back Better? The Build Back Better? Some people laughed. Okay. I'm not going to claim that I know everything about Build Back Better, but I know a lot about Build Back Better as it pertains to retirement plans. So there were provisions added in Build Back Better that were intended to prevent the mega millionaire billionaires from using Roth IRAs and investing in startup companies and creating lots of tax-free profits. And so they intended on eliminating the, call it loopholes, that some of these folks were utilizing. One of them was by the name of Peter Thiel. There was a ProPublica article that reported that he made millions of dollars investing in founder shares of PayPal. And then when he eventually, they sold to, I think it was eBay, they made millions of dollars, and it was all tax-free in his Roth IRA. And so the government started creating provisions within Build Back Better to prevent these types of things, and we're not going to go into all the details, but it was not intended to stop the everyday real estate investor from using their IRA to buy a rental property, do an occasional fix and flip, or do occasional private lending. There's nowhere in any of the legislation provisions that would eliminate those types of investments. I had a lot of people that were reaching out to me during that period of time because it was very turbulent. We had people that were calling up and talking to my staff or one of our other 400 associates in our organization and saying, I heard self-directed IRAs were put into law as prohibited completely, right? Because you can imagine, once people start reading the headline articles, what do you think happens? The truth gets distorted. And so people thought that self-directed IRAs were going to go completely away. The one thing that I will mention that's really important with the proposed legislation is there was a provision which would eliminate a facet of owning real estate in an IRA, but a facet that at Equity Trust and myself, we don't condone, we don't endorse, and we don't even facilitate. And that's what's referred to as a checkbook LLC IRA. Has anyone heard of a checkbook LLC IRA? Okay, so what a checkbook LLC IRA is, for those of you that aren't familiar, it's where you take your IRA money, you work with a custodian. You wouldn't be able to do this, by the way, with Equity Trust because of the risk factor. We're not comfortable with this type of structure. And you use a custodian, and then the custodian directs the money to an LLC checking account. So you actually form a specific LLC that is specific to your IRA and your IRA only. And then you become the manager of that LLC that is owned 100% by your IRA. And then you direct the money from your custodian to a bank account for that LLC. And the companies out there that sell these types of accounts, I should mention that most of them have zero regulatory oversight. To give you an example, in contrast, Equity Trust, we are regulated by the South Dakota Division of Banking. So we have a trust charter from the South Dakota Division of Banking. There's regulatory oversight, which means there are strict controls around what we do, what we say, and how we do things. And so these companies promote these checkbook LLC IRA structures so that you can move with incredible speed. The problem is there are a lot of investors out there that make a lot of mistakes with these types of systems. There was, in fact, a tax court case in November of 2021 called the McNulty case, and it actually had to do with holding precious metals, not real estate. But the tax court spent a great deal of time on this aspect of unfettered control. So in other words, we know that the regulators frown upon this type of structure. The provisions in the legislation in the Build Back Better would make a checkbook LLC IRA completely prohibited. In fact, if you had one, you would have to unwind it within 2 years and take everything out, or figure a way to liquidate all the assets and get it into cash directly with a custodian. So in terms of regulatory and reg changes, the good news is all of those IRA provisions were eliminated. And again, investing in real estate, buying rental properties, private lending, everything that I would be showing you this evening was never on the table whatsoever as an issue. So when people were reaching out to me before the the turn of the year, and they were scared about all of this, I said, we're not worried about it. We're not impacted because we're not teaching investors how to do things that are skirting around the law or exposing loopholes. We're here to show people how to run the business the right way. All right, so that's my regulatory update. There is one other thing that I'll mention, which is the Secure Act, which is a really interesting, if you're interested in light reading, you can check it out. It's called the Secure Act. Most people didn't even know it passed, even though it was one of the largest pieces of legislation in terms of retirement plan reform, and it kind of just passed everybody up. But we'll get into that in a little bit here. So this financial equation, eliminating taxation, leading us to an abundant retirement. And abundant retirement means different things to different investors. You know, for some people I work with, an abundant retirement means just merely preserving their capital. The inflation rate in January of 21 was 1.4%. January of 2022, does anyone know what it is, or was, is? 7.5%. So what that means is investors have to make, at minimum, 7.5% return in order to just preserve their capital, right? In order to just break even. This is pretty scary. And for our investors, they're constantly trying to outpace the traditional financial markets. Now, sometimes that can actually be very difficult to outpace the traditional financial markets, right? So we can look at periods of time over the last 2.5 years where people can say that they made nearly a 20% return on investment. Since January 1 to today, although the market did rally today, I don't know if you saw it, did rally today, but it didn't. Was it back down at the end of the day? Back down to the end of the day. So it picked up in the morning, I left, didn't see it, and it went back down about 10%. Now, I'm not here to say, just like Mr. Wilcox mentioned, I think it was right what he said, which is, hey, you can't tense up and make irrational decisions. But it's important to think about diversification. And that's what we talk about, is diversifying into real estate and many other types of assets, both alternative and traditional financial stock market type investments, if that's what makes sense for you. If you're somebody that says, hey, I don't want that exposure, I want to be all in real estate because I'm an expert professional real estate investor and this is what I do, then by all means, that's entirely up to you. I'm not here to give any type of financial advice or prognosticate what's going to happen in the financial markets. But I certainly can tell you that a lot of investors that have been coming to our organization and migrating to our organization have a great deal of concern with respect to what's going to be happening in the coming weeks and the coming months. So the Fed Reserve is going to, Jerome Powell will make an announcement in the next few weeks. We know that interest rates are inevitably going to change. Will the stock market rally? Will it not? I don't know. I can't give you an answer to that. But this is something where it might be a good idea to have a conversation with your financial advisor. If you want to start peeling off a portion of your portfolio and investing into real estate, now might be a good time to have a conversation with your financial advisor to determine what you feel comfortable with. And if you want to include myself and my team at Equity Trust in that conversation, we're happy to do that. We work in teams with financial advisors every day to make sure that you're exploring all of your options and you're making a well-informed decision and you're not making an irrational decision. Okay? So think about this financial formula, what an abundant retirement will look like for you. Most investors that I work with, they're looking into this because it can be a hedge against inflation, like we mentioned. It can be a great hedge against potential stock market risk. And it can also be a great hedge against rising taxes. Because a self-directed IRA, and particularly a Roth IRA, you're able to create wealth, you're able to generate profits in a completely tax-free environment. So let me give you an example of what I mean by that. So the way I instruct and the way that I help people understand how everything works is through client investment examples. So I hope you guys are okay with that because the duration of the program is just going to be one example after another. So Kevin and Cynthia are two Equity Trust investors, and they came to Equity Trust in 2010. What happened just prior to 2010? 2008. So Great Recession, their words, not mine. They took about a 40 to 50% haircut on their 401k portfolio. That was solely invested in mutual funds. that were 100% or near 100% correlated to the traditional markets. That was the reality. Now, the good news is Kevin and Cynthia didn't irrationally sell everything off in the Great Recession. They waited because, as many of you know, portfolios rebounded. So the portfolio rebounded, and then they were in a position where they were able to liquidate everything and move their 401ks over into self-directed traditional IRAs. So remember that. The first step is they took their 401ks and they did a rollover into self-directed traditional IRAs. From there, they converted their funds to Roth IRAs. This is an important piece here. It doesn't mean everybody in this room has to convert money from tax-deferred to tax-free Roth, but it's an important element in Kevin and Cynthia's story, and it might be an important element to you. So they took their money from their traditional IRAs, they converted it over to Roth IRAs. They had to pay some taxes at that time. So they started with about $100,000 in their tax-deferred IRAs, converted it over to Roth IRAs. They paid taxes when they did this because they went from tax-deferred to tax-free Roth. When they did this, they paid about $35,000 in taxes. This is what happens when you do a conversion from a traditional to a Roth. But here's what they did from there. In 2010, they bought a property for around $25,000 to $30,000. They put about $15,000 worth of work into the property. And then from there, they sold the property on owner financing. Has anyone bought and sold on owner financing before? Okay, so they bought a house, they renovated it, they forced an incredible amount of appreciation. It was somewhere around $35,000 to $40,000 in appreciation, sold it on owner financing. In a year and a half, they have a path to home ownership program that they have. So their goal is put a qualified buyer in the house, help them restore their credit, and then in a year and a half, they're going to refinance at a lower interest rate, right? Makes sense for the buyer, and then their IRA is cashed out. Make sense? So what happened in a year and a half? They replenished their capital, and they recognized their profit at that time. So they were able to grow their Roth IRAs from about $100,000 over the course of about a year and a half to anywhere between $180,000 to $200,000. And then following that process, they bought another property, and then a third, and a fourth, and a fifth. And so over the course of 10 years, they did over 20 real estate transactions. And now they have, in 2022, they have over $1 million in properties, and they're generating $130,000 in tax-free cash flow on an annual basis. Not only have they done buy, fix, and sell on owner financing, they also do buy, fix, and sell on lease option to purchase. And then they do have some just traditional buy and hold rentals still in their Roth IRA portfolio. When they started this process, they were under the age of 59 and a half. They are now over the age of 59 and a half. 59 and a half is an important age to write down. That is the qualified retirement age in the United States. And so now that they're over the age of 59 and a half, every year, should they choose to do this, they can take a distribution from their Roth IRAs. If they wanted to take up to the $130,000 in cash flow, they can certainly do that. And they don't pay a single dime of tax because it's all in their Roth IRA, which is a tax-free account. Now, when I asked them, I asked Kevin and Cynthia, do you plan on using this money, or what are you doing with this money? They said, we don't plan on using any of this money at all. They have about 60 rental properties outside of their retirement plans, so they have other wealth elsewhere. Their goal is to use these Roth IRAs as legacy planning tools, estate planning tools. So if you set up your IRA properly and you name the appropriate beneficiary, then you can set up your family for success and put them in a more tax advantageous arena. So in their case, they have over $1 million in properties, over $130,000 in cash flow coming in every single year. Their plan is to leave their Roth IRAs to their children. If their children have children, they're going to leave it to their grandchildren. That's called skipping a generation. You might hear of it called a stretch IRA. Stretch IRAs really went away in 2020, and here's the reason why. So the Roth IRAs will be left to the grandchildren, tax-free, which is good, right? They don't have to pay any taxes at all. When they take the money out, they don't have to pay taxes. But under the Secure Act that was passed December of 2019, went into effect January 1 of 2020, that Roth IRA will have to be used within 10 years. Or in other words, they would have to distribute all the money in 10 years. That is the children or grandchildren when they inherit it. Now, Kevin and Cynthia, in their lifetime, they can continue to grow the Roth IRA. They never have to take any money out unless they really want to. When they leave it to the children or grandchildren, they're going to have 10 years to distribute that money. Now, when they rewind the tape back to 2010, they paid $35,000 in taxes. But now they have over $1 million in properties and over $130,000 in tax-free cash flow. Well, if they kept that in a traditional IRA and didn't convert it, let's say they took $100,000 out of a traditional IRA over 10 years and paid a 20% tax. That's $20,000. That's $200,000 in taxes that they would end up paying in the long term. Now, that's a hypothetical situation, but that's likely going to be what their tax rate would be had they not converted from a traditional to a Roth. Instead, they paid $35,000 in taxes. Now, I know that's a lot of numbers there if you're not following with me. The analogy that's used is you either pay taxes on the seed or you pay taxes on the crop. So in Kevin and Cynthia's case, they knew that they inevitably would end up paying a lot more taxes on the crop, so they got the taxes out of the way in 2010 when the seed was much smaller. And their goal is to leave it to the grandchildren or children, if the children don't have grandchildren, and it's tax-free to them. Because see, if you leave a traditional IRA, a tax-deferred IRA, to your children or grandchildren, they're going to have to figure out how to distribute money over 10 years and not impact their overall tax basis in a significant way. So I've worked with investors that have millions of dollars in their traditional IRAs, and they're concerned with respect to leaving it to the children or grandchildren, and the children or grandchildren having to figure out how to withdraw this money over 10 years. Now, I'm not saying that everybody in this room should convert all their money to Roth IRAs, because for some people, it might make more sense to just continue to invest with a traditional IRA. All right, but all I want to do is give you the options of traditional and Roth, and then you can evaluate and make the decision on what makes the most sense for you. If you think you're going to make, if you're young and you think you're going to make some really aggressive returns, like Kevin and Cynthia in the Roth IRA or in the IRA, let's say in general, it might make sense to do it in a Roth IRA. If you think your returns are going to be fairly modest, then it might not make sense to convert to a Roth IRA. You could even speak with your CPA, and I would encourage you to do that to evaluate on what's going to make the most sense for you. So in summary, for Kevin and Cynthia, they're diversifying their retirement portfolio outside of the traditional financial market. They're leveraging compounding interest in the absence of taxation. And they also are putting their properties, some of their properties, in a position that's going to avoid probate. So that's another aspect of IRAs, self-directed IRAs, that a lot of people don't consider. IRAs avoid probate. The IRA, when you pass away, is not going to have to be caught up in a lengthy and burdensome court process. Now, I understand some of you might have rev trusts, living trusts, and I respect that, but IRAs have their own protection. In addition to that, IRAs are also protected from creditors. And I say this incredibly passionately because I can't tell you how many investors I talk to day in and day out. And unfortunately, by the time I talk to them, I can't help them. What they did is done. I've had people that have taken hundreds of thousands of dollars out of retirement plans to go out and buy real estate because they didn't know they could use their self-directed IRA to invest in real estate. Who has done that or has heard of someone doing that before? Has anyone? I know Anna has. Okay, Tony has in the back. Additionally, I had someone recently, a guy wanted to debate me, and we got in such a heated argument we had to just end the call. And we just won't have a business relationship together because I won't do business with someone that thinks like this. So he's advising people to distribute money from their IRA, pay taxes and penalties, because when you take money out prior to 59.5, you have a 10% penalty and ordinary income taxes. So he's advising people to take money out of their retirement plan, pay a lot of taxes and penalties, and now that money becomes exposed. Creditors can come after it potentially. In addition to that, probate process if you're not set up properly. So you're taking the money out of a tax-sheltered entity and you're exposing it to all of this. And this is what he's telling people to do, to use that money to then go out and buy real estate. Well, we could buy real estate in the self-directed IRA. We don't need to take it out of the IRA. And so then we get into tax simplification. So what you're going to learn is when your IRA owns rental properties, for example. So Kevin and Cynthia, they have some owner finance notes, they have rental properties, they have some lease options. All of the income goes into the IRA. There's no Schedule E. There's no need to factor in depreciation because you're already in a tax-exempt retirement plan. I've also had some people that say, well, John, you give up depreciation when you own rental properties in a self-directed IRA. Has anyone heard of that before? Doesn't make sense, John, you give up depreciation. Well, what happens after you depreciate a property for many years and then you sell the property? Well, you could 1031 exchange it. That could be a good strategy. You have capital gains. Your depreciation recaptures, right? Recapture depreciation. You're just kicking the can down the road. You're going to pay taxes at some point or another. Now, that's okay. That's just reality, right? It doesn't mean we don't want to own rentals outside of our IRA. My wife and I own plenty of rentals outside of our IRA. But we also own rentals inside of our IRA because we have the advantage of selling the property, not paying long-term capital gains tax, and we don't have to worry about recapture depreciation. So just remember that IRAs, you're not getting depreciation because you don't have any income that's taxable. Because you don't have any income that's taxable, therefore, you're not going to have the benefit of depreciation. With a Roth IRA, that becomes even more apparent. There can be some arguments that with a traditional IRA, you got to pay taxes when you take the money out, but you're going to see some investors, especially Kevin and Cynthia, who I talked about, that use Roth IRAs and own rental properties. Yes, they don't get depreciation, but the upside is the tax-free benefits when they begin harvesting that account. So just remember those three aspects of using self-directed IRAs: diversification, the tax-exempt status, and being able to avoid probate and protections against creditors. All right, let me talk about real estate joint ventures. So this is, I would say, probably the most exciting example that I'll give you all evening. Where are the folks that are doing fix and flip transactions? All right, any fix and flip transaction investors? Who's done fix and flip investments? All right. Okay, so this is Scott and Kate. Now here's Scott's situation, and his situation I would assume is going to relate to some of the people in this room. So Scott set up a Roth IRA back in 2015-ish, and he had about $24,000 in the Roth IRA. And he had the Roth IRA just sitting there with $24,000 in it for about 3 years. And finally, he just got sick and tired of the money just sitting there not doing anything. Who has felt that way? Who's had a few of us, who's had a self-directed IRA, and maybe you've done an investment, but now you feel like you stalled out, or maybe you've never done an investment because you don't know how it works, you don't know how to do it. In my experience, that's the biggest gap we see in the self-directed IRA industry, is that investors just don't know how to use their self-directed IRA correctly. They need someone to help them. They need a system to walk them through it, a blueprint, checklist, things to make it easy for them. And so Scott came to one of our seminars, and at this time we did an 8-hour class. We did these on Saturdays. Who's been to one of our 8-hour classes? I know a few folks have. Okay. We used to do one here once a year. I think it was about 2.5 years ago. And so we came to one of our 8-hour classes, and this is the way we used to operate pre-pandemic, is we had these 8-hour classes all across the country. Some people will go to 3 to 4 of these 8-hour classes in various cities across the country. They'd fly all the way to California if they have to, so they could sit through another class so they could understand how this stuff works. We've since then, fortunately, created a little bit more automation here, make it a little lower cost for you, and create a system that can walk you through this without you having to commit to an all-day Saturday program. And so Scott came to this event, and an investor partner of his, a friend of his, that he knew from his local RIA in Milwaukee, her name is Kate, she was at the event as well. And Scott only had $24,000 in his Roth IRA. He was trying to figure out how to use the account. His price point on properties was between $200,000 to $300,000. And his issue was, how do I take $24,000 in a Roth IRA and fit it in a $200,000 to $300,000 deal? Couldn't figure it out. He thought about coming in and finding private money and having a private lender loan to his Roth IRA. But then he learned about this scary tax called unrelated business income tax. Who's heard of that? UBIT tax. So there's this scary tax, and by the way, it's not all that scary. You just got to understand how it works. But there's this tax called UBIT tax. It's a special tax on IRAs when IRAs borrow money. There is a method to borrow money with IRAs to buy properties. We'll talk about it. But in Scott's case, he didn't want to have to deal with this. So he came to the seminar and he learned about this concept of a real estate joint venture. And so his real estate attorney, we set up a phone call, and it was myself, his real estate attorney, and Kate, and we got together to talk about this transaction. So Scott had a transaction. It was a foreclosure. He needed $224,000 for the purchase and renovations. He knew he could sell the property in under 6 months and make about a $60,000 profit. But his challenge at that time, again, was how do I actually put this all together? So we got on this call, and we mapped out a real estate joint venture system. And it's actually quite simple. It's really no different, if you will, than any other real estate joint venture. There is some specific language with reference to the self-directed IRA. In fact, there's some very key important language with reference to self-directed IRAs that has to be put in here. And so what we did is we mapped this out, and we have this in what's called our Master Self-Directed Real Estate Handbook. And so we created this handbook for people like Scott so that they have the specific diagrams. So what we're able to do is draw out the specific diagram for Scott and his attorney. In addition to that, we had sample documents that we were able to provide. These are actual live documents. They're redacted. So we have the actual sample documents that we're able to provide to Scott and his attorney and Kate, and then they were able to take those documents and reference those documents to create the document that was ultimately going to be what they were going to use for their real estate joint venture. So Scott came in with $24,000 with his Roth IRA. Kate, his investor partner, came in with $200,000 using her Roth IRA and her health savings account. Yes, you can actually self-direct a health savings account. She only had about $20,000 in that HSA, but that money was earning 0% interest before she met Scott. See, Kate's problem was she had dry powder sitting on the sidelines, but she didn't have a deal. Scott had a deal, but couldn't figure out how to put it together. So Scott's the deal guy, Kate's the money partner. They all come together. They put this transaction together. Kate makes $18,000 in profit, and Scott makes $42,000 in profit on this real estate joint venture. So after the sale is completed, $42,000 in profit go back to Scott's Roth IRA tax-free. So he grows his Roth IRA from about $24,000 to over $66,000 tax-free, 0% tax. And then Kate, her Roth IRA and HSA makes $18,000 in profit. Now, I know someone's probably thinking right now, well, wait a second, why did Kate only make 9% return? Which is actually 18% annualized because it was under 6 months, just under 6 months. Why did Kate only make 9% on her money? Why did Scott make over 200% on his money? Scott's the one who found the deal, right? Kate was making 0% interest in her self-directed equity trust accounts. Scott came and helped put the deal together. Yes?
One moment.
Okay, so if you are contributing 70-30 as far as the amount of money each is putting in, you don't get your profits back the same amount?
Yes, great question. So Cindy, just to make sure everybody heard and understands, Cindy's asking, well, wait a second, if Scott partners with Kate and there's a disproportionate capital contribution, how can they take a disproportionate profit? And Cindy, I think you're thinking about self-directed IRAs with respect to proportionate ownership interest. Yep, so we'll go into that in a minute. I'll answer that question in more depth, but what's important to understand in this example is Kate and Scott are what are called non-disqualified persons to one another. See, the rules associated with self-directed IRAs you're going to find are pretty simple. There are what are called disqualified persons to your IRA. Just remember that people up and down the family tree are considered disqualified persons to your IRA. Your children, your grandchildren, your parents, your grandparents. You are a disqualified person to your IRA. Your spouse is a disqualified person. And then any business entity, LLC, corporation, that is owned 50% or greater by disqualified persons is a disqualified person. Now, for some of you, that probably sounds like a complete foreign language. That's okay. I have video training that walks you through the step-by-step process. What you need to take away from this class is Scott and Kate are investor friends. They met each other at a local real estate investor association, which means they are able to partner on deals and they can split up the profits any way that they want, any way that they agree. Now, if Scott and Kate were husband and wife, that would be a different story. Then they would have to make sure that they proportionally divide the profits and expenses, which I'll show you an example in just a few moments. All right, the difference between a traditional and Roth, just to wrap your head around this. When you hear traditional IRA, think tax deferred, meaning when you put money in, you get a deduction. You grow it tax deferred, and then when you take the money out after the age of 59 and a half, that's when you pay taxes. And you're going to pay taxes based on your ordinary income tax rate. So for example, if you grew a traditional IRA to $1 million and then took $100,000 out at 59 and a half, $100,000 would be added to your ordinary income, and let's say you're at a 20% tax rate, you'd pay $20,000 in taxes. In contrast to that, a Roth IRA is funded with after-tax dollars. So you put money in after-tax, no deduction, grows tax-free like Kevin and Cynthia, you take it out, you pay 0% tax. This is represented, it's probably a little hard to read here, but to go through it with you quickly, if I put $6,000 away every single year for 25 years, and I apply a 12% return every year, and a tax rate of 30% during the years of contributions, and a tax rate of 20% during my years of distributions, in a taxable environment, I'll have $601,000 saved. So every year, I have to pay taxes on my profit. Taxable environment, I have $601,000. In a traditional tax-deferred, tax-deductible retirement plan, I have $894,000 saved. So I am $300,000 better than the taxable environment. Then a Roth IRA is $1.117 million. So you see my Roth compared to my taxable environment is over $516,000. There's some really strong arguments that a Roth IRA can be very advantageous for investors. But remember, it really depends on your individual situation. I can't state that as an absolute fact for everybody. And I'm very passionate about not taking a one-glove-fits-all type of plan for every investor that I work with. All right, it's really individualized based on your individual situation, and we can help you through that process, and we have training and education around that. Now, I know some of you are looking at this, as it happens all the time, and they'll say, well, John, what about the difference between short-term capital gains and long-term capital gains and other types of tax classifications beyond just this example? Absolutely respect that and understand that. We could spend hours together on spreadsheets. I love them. I've done very long analysis on a variety of individual situations, and there are some circumstances, again, where a traditional IRA might make more sense for an investor. This is merely just to help you understand the difference between a traditional IRA and a Roth IRA. And then in just a moment, I'm going to share with you a solo 401k and how we bring these two together. I mentioned the disclaimer before. Just need to make sure I put this up on the screen for everyone, just for a few minutes, and I'll answer the question here while I do that.
I'm 60 years of age.
60 years of age. I can repeat the question. 60 years of age.
Okay. I'm 60 years of age. I open up a self-directed IRA. When can I start withdrawing out of it?
If you open up a self-directed IRA at 60 years of age, if it's a Roth IRA, and you've never had a Roth IRA before in your life, never had one with any other company, There is what's called a 5-year seasoning period.
Okay.
You have to be 59 and a half and 5 years.
All right.
So there is some urgency for those that are a little bit older to open a Roth so that way they can get that seasoning going. Now, good news is you can use the money for investment purposes. So you can invest, reinvest, redeploy,
Right.
and continue to grow that account, and then you just got to wait 5 years to start harvesting the money.
Thank you.
Yep. All right, yes.
Is that 5-year seasoning period apply one time on the first Roth, or like if you split it, you had 2 Roths or 3? Is it apply brand new to every time you open a different one or a new one? The 5-year clock starts again?
January 1 in the year in which you make your first dollar contribution. So that means that if you had a Roth with, let's say, Fidelity years ago, and then you open up a brand new Roth with Equity Trust, you're seasoned. The only 5-year seasoning that would be an exception to that rule is if you convert money from a traditional to a Roth, like Kevin and Cynthia did. That's what a Roth conversion is. If you convert from a traditional to a Roth, the amount you convert has to season on its own for 5 years.
Okay. But your seasoning period starts from the very first Roth that you ever created. You create 6 more later for some reason. You don't have to go through that 5 years on those.
You got it. You got it.
Okay.
And while I'm on the question, good? Okay, awesome. I'll move on. By the way, I'll be hanging out after. I know we're going to go to the cafe. I'll be happy to answer as many questions if I don't answer them here. But I do want to make sure I get through some more of the content. Last item on Roth IRAs. For those of you that are a little bit younger, if you take away anything from today's program, I'm not here to just endorse Equity Trust and come open IRAs with Equity Trust. That's not what I'm here to do. I'm really here to help you understand how self-directed IRAs can work for you, whether it's now, 6 months from now, 5 years from now, whatever it may be. But what I'll encourage you to consider, especially if you're younger, is open up a Roth IRA, at least go to a Fidelity or a TD Ameritrade or an LPL Financial and start putting some money in a Roth IRA. Just do it. Just open it up and start putting money in it. Because of the 5-year seasoning period that we talked about. When you look at compounding interest, you saw the slides. Even if you can only put it in something that's making you 7%, you're going to be better off because of the tax-free compounding effects. So at least open a Roth IRA and start putting money in it. And here's another thing. A lot of the younger folks that I work with, what they're very fearful of, and I was there too. You know, when I was in my 20s and I was working for a retirement financial company, and so I knew about the principles of retirement account investing, but I was worried that I was going to essentially put my money away into an account and I was going to end up throwing away the key, right? Locking it up and throwing away the key. What's interesting about a Roth IRA is whatever amount of money you put into that account, you can always take whatever you contributed out of the account 100% tax and penalty free. You just can't start grabbing the earnings, the growth, until you're 59 and a half and you reach that 5-year seasoning period. So for those of you that are a little bit younger with Roth IRAs, the good news is you have a little bit of a safety net there. The other important thing to take away is if you make too much money, and for those of you that are a little bit younger, if you're not making a lot of money right now, you're here learning about investing, you're likely going to get to that point where you're going to make a lot of money, and then the government's going to tell you that you can't contribute to a Roth IRA anymore. Who's heard of this before? Making too much money can't contribute to a Roth IRA. They're called MAGI limits, modified adjusted gross income limits. To give you a quick tutorial on that, we don't have time to talk about all the details, but if you're married filing jointly and you make over about over $200,000, if you're single, it's about $130,000. If you're making over that amount, then you're not going to qualify to make a full contribution to a Roth IRA. There's what's called a phase-out range where you can only put a little bit of money in a Roth, and then eventually it hits a ceiling and you can't contribute at all to a Roth IRA. The good news is there's a solution for that, and write this down, backdoor Roth IRA. Backdoor Roth IRA. And by the way, the legislation, the Build Back Better, was threatening this opportunity. So if this is something that you've been told you can't contribute to a Roth, you're going to want to start looking at doing this, and probably with some urgency, because it may not exist forever. Here's what a backdoor Roth is. You make too much money, you contribute first to a traditional IRA, which anybody can do as long as you have earned income, and then you immediately convert that money over into a Roth IRA. It's called a backdoor Roth contribution. That's not a legal term. You're not going to find that in the IRS guidelines. I don't even think you'll find that on the IRS website, quite frankly. It's sort of an industry term that's used. All right, so everybody with me on that? Contribute to a traditional first, and then immediately convert over to a Roth IRA. And I've had people that have been doing this since 2010, because prior to 2010, you actually weren't able to do it. Yes?
When you roll it into an existing Roth IRA,
Great question. So yes, you don't have to open separate Roth IRAs. You can fund your traditional, convert to the Roth. Fund the traditional, convert to the Roth. And you don't have to convert. Kevin and Cynthia converted their entire $100,000 401ks, but they did have other IRAs elsewhere. You don't have to convert all of your money into a Roth. Some people just do partial conversions, and they'll do them over the course of many years so that they can break up their tax burden over several years. Okay? Now, I mentioned that we don't give tax, legal, or financial advice, but what I'm absolutely here to do is provide education, information. I'll say some other resources following today's program. We have a YouTube channel. You can check us out there. Subscribe to our YouTube channel. We post videos almost every week on all different types of topics and new things that are coming out. For example, about a month and a half ago, I put out a video on master leasing, which is a great way, if you only have a small amount of money in an IRA, to actually enter into a master lease arrangement and then do a longer term type rental, anywhere between 3 months to 12 months is typically what we see. So if you are interested in additional material after today's event, we can certainly help you with that. There's going to be no shortage of education that we provide to you here at Equity Trust. All right, moving on to the solo 401k. So this isn't going to pertain to everybody. We're going to go through it quickly. But I do want to show this to you because for some of you, it might make sense for you right now, and it could make a major impact on you. For other people, it may not make sense right now, but it may make sense for you in 6 months from now, 12 months from now, 2 years from now. So the solo 401k, I want you to think of it as a combination of both the traditional and Roth IRA. There are some eligibility requirements we need to go through. Before I do that, let me mention one of the strongest features and characteristics of a solo 401k is that you're going to learn you can make significantly higher contributions to a solo 401k as a small business owner than you can an IRA. So an IRA, you can contribute up to $6,000 per year when you're under the age of 50, up to $7,000 when you're 50 and over. So if you're taking notes, $6,000 under 50, $7,000 when you're 50 and over. If you have a spouse that's not working, that's okay. You can do what's called a spousal IRA contribution. A lot of people don't know about this. It's very effective, which means you can have 6 going into yours, 6 going into your spouse's. Now you got 12,000 combined. Another important fact, we are before the tax filing deadline of April 15th. So you can make a contribution for 2021 and 2022 at the same time. So think husband and wife, let's say they're 50 or over, they can do $7,000 for 2021, $7,000 for 2022, $14,000. The other spouse does 7 and 7, so now combined they have $28,000. Now, if you're in a situation like Scott, putting together a real estate joint venture, now you have plenty of capital in order to be able to go out and deploy that into real estate investing. Now, it doesn't have to be that amount of money. You could do a real estate joint venture with $5,000. You could do a real estate joint venture with $2,000. You want to be careful and not try to do a fabricated transaction, I'll call it, where you put $100 into a deal with an IRA. Obviously, this is a regulated space. This is a tax-free account. The IRS has regulatory oversight. So you want to make sure that you have some skin in the game with the IRA. So we don't want to get cute with it, so to speak. We want to make sure that we put some capital into that deal. All right, but that's contribution limits for IRAs. So in addition to your earnings and growth, you make your contributions. You're not limited by 6,000 or 7,000 with respect to your growth. So a good example, does anyone do real estate options here? Anyone do real estate options? That can be a great way to grow your IRA as well. We don't get into detail in this class, but it can be a great way to grow your IRA. An investor friend of mine, Scott from Rochester, New York, he put an option on a self-storage facility. And that option gave him the right to buy the property at a future date at a predetermined price. He paid $2,000 to the seller to put the option on the property. He then turned around and sold that option contract. He assigned the option contract. Think of it like a short-term wholesale flip. Assigned it to an investor buyer. It was an A to B to C transaction. A closed with C, and Scott's assignment fee was $20,000, all of which was tax-free in his Roth IRA. So that was well over the contribution limit of $6,000 for him, but that was okay because it was profit in the IRA. So just quick tutorial on real estate options. For those that are interested, I do have more info on that as well. All right, to the solo 401k. Here's what's really neat about the solo 401k. If you're a business owner, you can open up this plan and you get two buckets as a default. You get a traditional bucket and you get a Roth bucket. So you can either put money in and get a tax deduction for yourself and your business, or you can put money in after tax into the Roth bucket. Here's how much you can contribute to one of these accounts. Here's what gets really exciting. As an employee, so as a business owner, have you ever heard of you wear two hats, an employee hat and an employer hat, right? So as an employee, you can contribute up to $20,500 when you're under the age of 50. When you're 50 and over, you can contribute up to $27,000. All right? So as you can see there, right from the beginning, you can contribute anywhere between 3 to 4 times more, depending on your age, to the plan. This $20,500 or $27,000 can go either into the traditional bucket where you get a deduction, or you can put it into the Roth bucket, which is all after-tax dollars, and now you got more Roth dollars. In addition to that, you can have your Roth IRA. Do you think most people that self-direct into real estate fully fund their traditional bucket, or do you think they fully fund their Roth bucket? The Roth. They fully fund their Roth bucket. And some people are only paying themselves just over the amount that they need to fully max out that contribution. So if you're somebody that doesn't have a lot of supported earned income in your business, that being income that you're paying Medicare and Social Security tax on, you may look at just paying yourself what you need to in order to fully maximize out this plan. Now, it doesn't stop there. That's the employee side. You then have an employer deferral. Think of it like a match, right? 401ks with companies you work for, you get a match. In some cases you don't. So think of it like a match. Between your employee contribution and your employer deferral, you can defer up to 25% of your W-2 income or 20% of your self-employment income to get you to $61,000 when you're under 50, $67,500 when you're 50 and over. Let me give you an example for anyone that went into screensaver mode, because I know that was a lot in a short little bit of time. That's okay. I have a 45-minute training all on solo 401ks, does a deep dive for you. All right, so John is 50 years old, and John, let's say, is a active wholesaler, flipper, and John has an LLC, XYZ LLC, and John makes $150,000 in Schedule C income, and then he passes $100,000 of that through to his Schedule SE. What does this mean? Long story short, what this means is John is actually claiming $100,000 in earned income. Earned income meaning income that you're paying Medicare and Social Security tax on. Call it payroll tax. All right, that's the price to pay to get in the game, so to speak. You're going to learn that with a solo 401k, if you don't have any earned income, meaning you don't have any income that you're claiming as self-employment income and paying Medicare and Social Security tax on, you are not going to qualify for a solo 401k. You can't even open one up. Under the guidelines of the IRS, if we go directly to the IRS website, you'll learn you can't even have the plan. That's okay, because it just might make more sense for you to have an IRA. That's why we take an unbiased approach. It's either an IRA or a solo 401k, or sometimes it's both. And we can work with folks and offer any of these types of programs for you. I will say, as a disclaimer, that there are some companies out there that can only sell you a solo 401k. And I talk to those people almost every day because they call into my office and they say, here's my situation. The company that sold me the solo 401k at a seminar, I can't get a hold of anymore. And I don't know what to do, and I don't have any earned income. And the first thing I do is I have them watch the 45-minute training, and they learn that they should never even open the plan. They should have never opened the plan from the very beginning. So that's just a quick lesson in making sure you're getting good information from good sources. But back to the example, John here is paying himself $100,000. He defers as his contribution. I know it's hard to see, but $27,000. So John's 50 years old. He can contribute up to $27,000. So he puts the full $27,000 into the Roth bucket. Then on the deferral side, he does 20% of his $100,000, which comes out to $20,000. And he puts that into the tax deferred bucket. That's the employer deferral. Why do you think the employer deferral has to go into the tax deferred bucket? He still gets the money because the business gets a tax deduction for it. It's just like 401ks when you work for a company, right? They don't match you just because they like you. They match you because they get a nice tax deduction for it. It works the same with this plan. But here's the deal. What we can show you how to do is what's called an in-plan conversion if you want to. And then John converts this $20,000 into the Roth bucket, leaving him $47,000, which is all 100% tax-free. So what I'm sharing here is you got $100,000, you pay yourself $100,000, you pay the taxes on that money, you can get all of that into, that is up to $47,000 in that example, into the Roth bucket of the solo 401k. So at the end of the day, solo 401ks are great for people who have enough supported income. And then the last eligibility requirement that you need to be aware of is you cannot have any employees with the exception of a spouse. So if you have full-time or W-2 employees that work for the business, a solo 401k is not going to work for you. You're likely going to want to look at just opening an IRA instead. But we can work with you on an individual basis in terms of what's going to make the most sense for you. Yes, Chuck?
You say employees, does that include contractors?
1099 contractors would not be included. Those aren't employees. It would be a W-2 employee. All right, so write this down. 3 methods to finance real estate transactions with an IRA, and then I'll go through a couple more examples, and then we'll start to wrap up. So 3 methods to finance real estate transactions. The first method is where your IRA is a cash buyer. So no debt on the property. IRA buys it free and clear. IRA pays for all fix-up and repairs. IRA receives all profit from the rental or sale of the property. The second method is the IRA partnering. The IRA can partner with you, yourself. The IRA can partner with a spouse. The IRA could partner with another IRA. The IRA could partner with a non-family member. I already shared the joint venture example with you. So there's lots of ways that you can partner your IRA. I've even seen it whereas upwards of 10 IRAs and investment accounts are all partnered together on one transaction. You can partner on private loans as well. So you can make a loan to a real estate investor secured by property, and you could have multiple IRAs in that transaction. I do it quite frequently. I have a traditional and a Roth IRA, and I make loans to investors, and sometimes I'll partner both of those accounts together. Yes, I'm really passionate about Roths, but I still have traditional IRA money because I'm not ready to convert it all into a Roth IRA, trying to convert it over in stages here. So that's method number 2. The last method is the IRA can borrow money, but when borrowing money, it has to be on what's called a non-recourse loan. So you can write that down, non-recourse loan. What that means is in the event of a default, the only recourse that the lender has is against the subject property. Conventional lenders will not loan to your IRA. Why? Because when you get a conventional loan, you have to sign a document typically. You personally have to sign a document. Do you know what that is called? Anyone? Personal guarantee. Under the provisions of 4975, it's actually 4975 C1B, the extension of credit, it's considered a prohibited transaction. That's if you're interested in light reading out there. Again, that's 4975 of the Internal Revenue Code. I know everybody's going to go home tonight and Google that. That was joke number 2. Again, that's one of those dry ones where you just laugh at me, okay? All right, so you can't obtain a traditional loan. You have to get a non-recourse loan. I do have a list of lenders that I share with individuals, and I have some additional training on how that works. It is important to understand, and I referenced it before, that when your IRA borrows money in the form of a non-recourse loan, your IRA has to pay a special tax called unrelated business income tax. And the way that works, to give you an example, is if you borrowed $50,000 to buy a $100,000 property, you'd be at about 50% leverage. So 50% of your net profit would be subject to this unrelated business income tax. That's the one instance where you have depreciation and you have expenses that you can write off because you have a tax liability. That's really the only instance when you have your IRAs where you're going to use depreciation and expense write-offs. So a lot of investors I work with, they do get to a point where they have enough write-offs where the tax exposure is minimal or they actually show a loss. So that's something we can work with you on an individual basis, and we do have some additional training. Yes, Cindy?
Okay, so the, that UBIT can be written off with depreciation,
Yes.
but no other expenses?
Well, if you have leverage, then you can write off your expenses as well.
Okay, so
Yep.
you can lower what you owe for UBIT on that? based on
Correct.
that? Okay.
Exactly. So there is a strategy to buy properties with debt, with non-recourse loans. Now, I will say that most investors with IRAs, they're either a cash buyer or they're partnering. All right, but yes, you can use your IRA to do debt financing. One last thing, and then I'll take the question, is under a solo 401k, this is one of the most attractive features of the solo 401k for a lot of real estate investors. If you borrow money, non-recourse, you can't do this with owner financing if you buy an owner financing, but if you borrow a loan, you borrow money, just a straight loan, then your solo 401k would actually be exempt from this debt-financed unrelated business income tax.
So that
Yes.
seller financing is going to trip up the UBIT as well, correct?
That's correct. So if you bought a property with your solo 401k on owner financing, you'd still have UBIT.
And will that apply to the 401k? You said something about that.
Yes, so IRA or solo 401k, you buy properties on owner financing, you're going to have UBIT tax. If you sell a house on owner financing, that's just a note mortgage in your IRA. You don't have to worry about it. Okay, so those are the three methods to finance properties. Now let me give you some examples. This is Gary. This is going to be a cash purchase. Gary bought this duplex for $68,000. This is right outside of Cleveland, Ohio, with his Roth IRA. This is his tax-free Roth IRA. Bought it for $68,000. He put $20,000 worth of work into it. The work that he put into the property, $20,000, was all paid for from his IRA. Important to understand that if your IRA owns a property, your IRA has to pay for all the expenses. You personally can't go writing checks because if you do, you're a disqualified person and that can be considered a prohibited transaction. So he was in the property for about $88,000. He's renting it for $900 on Unit A, $950 on Unit B. His monthly net operating income is $1,400. So I'm saying net operating income because he bought this property as a cash buyer. There's no debt on this property. The property has an appraised value right now of around $140,000. So if he sells this property after closing costs, let's call it a $40,000 profit. It's in his Roth IRA, so there's no long-term capital gains tax. He doesn't have to worry about depreciation recapture. All of the income, $1,400 on a monthly basis, is tax-free. Gary just turned 59 and a half, so if he wants to, he can turn around every month, and that $1,400, after going to his Roth IRA with Equity Trust, can be turned around and sent directly to him with 0% tax liability. So rental properties in Roth IRAs can make an incredible amount of sense because you have no long-term capital gains tax, you have no ordinary income taxes on any of your rental income. You have a cash flowing asset, a tax-free cash flowing asset. Yes, Cindy?
Okay, so on that house there, if you wanted to get your money back out of it and you got, let's say, a private lender,
Yes.
would you pay UBIT on the amount that they, like, you want to get your 68,000 back, you'd pay UBIT on 68,000?
Yeah, so if I went out to a private lender and they made a non-recourse loan to my IRA, so I did actually a cash out refinance on the property, if you will, to pull out cash to buy another property, then I have UBIT exposure, percentage of the profits. And the percentage of the profits is based on the damage. So if I borrow $50,000, then 50% of my profits are going to be subject to UBIT. Not 100%, but a percentage based on the debt finance percentage of the property.
Okay.
All right, so here's an example of partnering. So Scott and Kate, remember, they're not related individuals. They're not disqualified persons. But what happens if you partner with yourself or partner with a disqualified person? So in this example, Gary didn't have enough money in his Roth IRA to take down this entire deal for the purchase and rehab. He needed about $72,000. Purchase price was $41,500. He partnered his Roth IRA at 75% and then his non-IRA capital at 25%. So at closing for the $41,500, 75% came from his Roth IRA with Equity Trust, and 25% came from his LLC. Let me show you the exact titling. So the titling that was used on the contract and which was represented on the deed was Equity Trust Company Custodian FBO Gary's IRA undivided interest 75% and his LLC undivided interest 25%. So it was a 75-25 deal. His Roth IRA made $26,000 tax-free, and then his non-IRA entity made $8,600. So the $30,000 in repairs were paid out 75-25, and then all the profits went back 75-25. So if you're going to partner with family members, you're going to partner with disqualified persons, you just have to make sure that the percentage split is proportionate with the initial capital contribution. This is the titling that you use. You don't need to form an LLC, trust, or other entity. I do have occasions where investors want to form an LLC or a trust. I know there's a program coming up on land trusts, which I think makes a lot of sense. And so we actually have diagrams in our master transaction handbook that outline this. So for investors that want to work with their attorney and they want to set up a more advanced structure, you have the capability of doing that with your self-directed IRA. But what's important to understand is you don't need to do that. 98% of real estate transactions that we process, and we have over 17,000 properties owned in IRAs right now, we have processed well over 100,000 transactions over the last 40 plus years. And less than 2%, call it 2%, have involved an LLC, trust, or other entity. Typically, all properties are bought directly in the name of the IRA. The IRA is an entity in of itself, and you'll actually see, to keep your name off public record, you can use your account number instead of your name. Let me share another example with you, and I use my account number, not my name. So this is a rental property that I own in Maple Heights. So this is just right outside of Cleveland. Again, that's where my hometown is. And when I bought this property, it was in March of 2020. I bought the property for $63,000. There's an upstairs and downstairs unit. Each tenant is paying $750 a month. And I split this one up, 55% my Roth, 35% my traditional, and then 10% is me. So I have 10% equity in the property, my Roth has 55, and then my traditional is 35. And I just make sure that all my profits and all my expenses flow 55, 35, and 10. So that's another partnership example with disqualified persons, with myself. Now I could plug and play my wife, I could plug and play children, I could plug and play parents, right? You can get really creative with this. Remember, when you're partnering with disqualified persons, you have to make sure everything is done proportionally. If I'm partnering with non-disqualified persons, like in the case of Kate and her investor friend Scott, I don't have to worry about this percentage split. So I can actually take a more meaningful profit with my Roth IRA. Now, in terms of processing this, how do you actually put this all together? Equity Trust has a digital processing portal. So dawn of the days, if you will, of having to manually process real estate transactions. And you can move with an incredible amount of speed. So this My Equity Digital Processing Hub allows you to process your real estate transactions all digitally. So think you're logging online into a portal, you're requesting an earnest money deposit. You can do this on your smartphone device as well. And within 3 minutes, you can process an earnest money deposit, and the funds can be sent out via wire transfer, ACH direct deposit, or we can process a check and mail that out to you. This My Equity portal also allows you to handle all of your bill pays. So as you have expenses that come up on your properties, we have a bill pay system for you to request checks. We also have, and this is fairly new, is a tenant payment center, so your tenants can send direct deposits back into your Equity Trust IRA. We have a prepaid card called Expense Pass, so for your purchases at Home Depot, Lowe's, let's make sure we mention Home Depot as a RIA vendor, you can actually use your prepaid card for those expenses. So it makes it really easy for you to be able to access the capital in your IRA to maintain your IRA-owned properties. And so this online digital system has a lot more. We can go into more detail with you on an individual basis based on what you're looking to accomplish. You'll also notice that you can, through this portal, invest in mutual funds, as well as get access to a brokerage platform to buy individual stocks. We're really not set up to be an active day trader type platform, but if you have an occasional stock or mutual fund you want to buy and you don't want to have to move your IRA money out elsewhere, you have the opportunity to do that. All of that being said, we're nowhere in comparison to like an LPL Financial, right? So if you're looking to stay diversified in the traditional financial markets, then you're going to want to make sure you go to an organization like that, and then just reserve your equity trust self-directed IRA for your real estate and alternative investments. And you can always go back and forth between those accounts. You don't have to be married to one individual account. You can have multiple IRAs. All right, so that just gives you a quick tutorial on the platform, the Equity Trust digital platform. We have demonstrations and tutorials for you so that you can learn more about how you can actually initiate transactions, log into your account, and process investments, not just real estate, but also private loans. So on the topic of private loans, last example for you, I mentioned that I make private loans with my self-directed IRAs, and it's a great way for my wife and I, when we have uninvested cash, to be able to deploy our uninvested capital to real estate transactions. And so we're still involved and have exposure to the real estate transaction, but we don't have the management, we don't have the dealing with tenants, we don't have the rental property management that we have with our other transactions. So it's been a great way for us to keep the velocity of our money moving. And so here's just one example of many that I can give you. This was a $50,000 loan that I made on this property. The rehabber, the borrower, he did a fix and flip on this house in under 6 months. I made a $50,000 loan, $25,000 with my Roth, $25,000 with my traditional, 14% interest, 8% for the first 6 months. What 8% flat means, it's sort of like a prepayment penalty. Whether they sell the property in 3 months or 6 months, I still get my full 8%. And then I have my 14% per annum if it goes past 6 months. So the interest clock just keeps ticking. Fortunately enough, on this transaction, it was sold 4 months later. My payoff was $54,000. So I had $4,000 in profit, and then I had my $50,000 in principal. My $4,000 in profit was tax-free in my IRAs. So I didn't have to pay a dime of interest income tax. I didn't have to report that on my 1040 as ordinary income. It was all tax-free in my IRAs. I mentioned at the very beginning, I have a loan that I'm looking to fund later this week, $100,000 loan, 8%, $8,000 in profit. That'll go back into my IRAs tax-free as well. So going back to the very beginning, compounding interest in the absence of taxation, that's what this is all about. This is how we get to our retirement goals and our financial goals in a shorter period of time, is by leveraging these self-directed IRAs, leveraging the tools afforded to us by the federal government. For some of you, that's an IRA. Some of you, that might be you take your 401k money, you take your 403b money, you take your 457, whatever type of account you have, and you migrate it over into a self-directed IRA. For other people, it might be setting up a new IRA and getting started. So what we're going to do this evening, we have what's called the Equity Trust Master Academy. And so I'd invite everybody to this Master Academy. Within this Master Academy, oh yeah, you got a question?
I'm sorry, this is probably a dumb question, but that UBIT tax that you were talking about, that's only affecting the person that's borrowing the money?
Yes, so it's only affecting the IRA that's borrowing the money. The lender, it has no impact on. So if I'm using my IRA to make a loan, I don't have to worry about UBIT because my IRA is not being encumbered by any debt. It's only if my IRA is borrowing money.
Okay.
Yep. Thanks. All right, so we have put together what we learned. I mentioned before that the way people had to learn how to do this and do it the right way, because there's a big gap in the education in terms of self-directed IRAs, is they had to come to these 8-hour classes all day on Saturday, and sometimes people would have to come to multiple of these classes. So what was great is through the pandemic, I had the opportunity, because I wasn't able to travel and speak across the country, I had the opportunity to build a state-of-the-art studio in our office in Westlake, Ohio, and I was able to put together a course that would make sense for real estate investors, so that folks didn't have to spend thousands of dollars flying all across the country to attend Saturday workshops. And so we created the Equity Trust Master Academy. And within the Master Academy, we have the Self-Directed IRA Master Course for real estate investors. It's an all-digital, all-online learning experience. And I'll share with you what the cost of this program is, but I do want to mention that this is not a, call it continuity program where you have to pay every month or an annual subscription. This is a one-time charge. And the idea behind this course is for you to ultimately bring together the tool, the self-directed IRA, with the investment strategies that are going to make the most sense for you. Because there's far too many people out there that I've seen, like Scott, for example. His account was sitting dormant for 3 years. 3 years he made 0% interest. Now at that time he wasn't in a 7.5% inflation rate environment. But could you imagine your IRA sitting around for 3 years with 7.5% inflation? What does that mean? 7.5% year one, we get to 15% year two, right? And then everybody do quick math with me, right? What we're up to like 22.5, right? That's the erosion effect. So taxes erode, inflation erodes our retirement balance. So we want to be able to continue to grow our retirement balance. We don't want our IRAs just sitting around doing nothing. That's a big problem. And we recognize that, and I've recognized that. See, if we don't help you make money, we don't make money. In terms of our maintenance fees, if you go to our website, trustetc.com/fees, you'll see what our fee schedule is. It's very simple. As you make more money, we make more money as well. Good news is as you make more money on a percentage basis, it actually goes down. All right, so there's an incentive there to continue to grow, and you actually, on a percentage basis, pay less and less as the years go on. So it's really simple in terms of how we're monetized and make money at Equity Trust. We're very transparent about that. We have to be. Just like Mr. Wilcox with LPL has to be transparent with fees. We have to disclose that in the financial space. It's really important. We take it very seriously, and we do the same thing. So we want to help you grow, and we want to help you make money. And we know that this course helps investors. It gives them the blueprints, the roadmaps, the instruction manuals, in order to be able to go out and find deals and put deals together with their IRAs. So let me share with you a little bit about the course itself. You're going to get a what we call beginner to advanced virtual class section of the course. And these are virtual classes that you can attend at any time, whenever you want, on your own time. They're all recorded. And if you're somebody that's more of a landlord investor, you want to figure out how to do buy and hold deals in your IRA, we have a specific course on that. If you want to do fix and flip transactions in your IRAs, we have a specific course on that. If you want to learn more about debt financing, UBIT, we even break down the calculations on a whiteboard for you. So in our virtual classroom, we're going to map out for you how to do these calculations and how you can do them fast so you can determine does the deal pencil out for you, does it make sense for you. We bring in one of the top non-recourse lenders in the country from North American Savings Bank. His name is Matt Allen. So he breaks down for you, if you want to do buy and hold deals, how to get financing, how the underwriting works, how you can leverage your IRA and do it in a very meaningful way. So if you want to go beyond just cash buying and partnering, we have the material in here. We do talk a lot about partnering, which we explored in this session. And then we go into advanced LLC and corporation structures. We can get really carried away here. I don't want to get too far out in front of my skis, but there is a way to, if you will, eliminate UBIT tax through what's called a blocker corporation. It's basically an LLC that's taxed as a corporation, or you actually set up a corporation. So there's some really creative ways that we can show you once you get to a point where your retirement balance grows and you want to get more creative on more advanced transactions that are going to incur UBIT. We can help you sort of soften the blow a little bit with the corporate tax rate instead of the UBIT tax rate, which could be as high as 37%. Real estate closing, so how do you actually close on a real estate transaction with your IRA? Who signs the documents? How does it work? The tutorials and the demonstrations are all built into this program. We even introduce you to an IRA-friendly title company called IRA Title Pro, which will be available here shortly in the state of Ohio. So if you want to close IRA deals fast and work with people that understand self-directed IRAs, we have that resource for you. If you don't want to sit through a lengthy class, we do have these micro lessons. We call them Take 5 videos. Everything from LLC structures, shared appreciation loans, paying for expenses in your IRAs, all the tutorials, all the demonstrations, all the walkthroughs, disqualified persons, how to partner, how to title the properties properly. When you go to closing, make sure the documents are appropriate, make sure the documents are in good order. All of that is in these Take 5 video series courses. And then we have the Master Transaction Handbook. So I mentioned before Scott and Kate. So they use the Master Transaction Handbook. This has all the diagrams. It has sample documents in the back. We didn't get into shared appreciation loans, but has anyone done a shared appreciation loan where you make a loan and you charge a percentage of the profits in addition to just interest? Has anyone done that before? So that can be a great way to make a meaningful profit in your IRA. For example, if you're funding like full purchase and rehab on a deal, you should get more than, right? You got a lot of skin in the game. You should get more than just maybe 13, 14% interest. They're not legal in all states, by the way. They are here in the state of Ohio, but we have those details in there for you. And then we also have, has anyone done partnership deals where they're doing larger transactions like apartment buildings or other commercial real estate where they're going to bring in multiple investors or partner multiple investors? Is anyone doing that or looking to do that? So we have multi-member LLC structure, so you can learn about how to put together larger transactions if you get to that point. Do you have a question, Cindy? Oh, okay. Good to go? Oh, you're good? Okay, all right. So that's the Master Transaction Handbook, and we created this handbook as well for, if you're somebody, by the way, you would get a copy of this evening. We created this because if you're somebody that is looking for private money, you're going to sit down with investors that might have IRAs, you can actually sit down with them with this material. You can even pull up some of the video content or send them links to some of the video content to get them more educated and more informed on using a self-directed IRA. So I have a lot of clients that are out raising capital and they're actually using this manual and the tools in the course in order to be more effective in their sales presentations with their potential private money partners, whether they're bringing them in as a joint venture like Scott did with Kate, or if they're using them as like a private lender. So that's the Master Transaction Handbook. You get a physical copy of that, and then you get the digital copy that's all built in the e-learning. Duo that flip houses with partnering their IRAs together. They share how they break down transactions, how they partner with tax, and they share do that and how they actions. And then, so the tutorials, you actually have guides. Trust. And let me pause for a moment and mention that if you have a self-directed IRA with another self-directed IRA provider, we did build this course so it can be agnostic. Meaning that if you do have an account with another self-directed IRA provider, a lot of the material and content is going to be absolutely relevant to you. So if you want to move forward with opening an account with Equity Trust, we'd be happy to do that for you, but it's not an obligation or a requirement of yours. We also have case studies built in this program as well. So we have hundreds of, and really I should say we have thousands of transactions in our database. But what we did is we've broken down the top 100, if you will, and we share this with you. So what I find in self-directed IRAs is you don't know what you don't know, and sometimes it's just a matter of understanding what the possibilities are. So that way, when you're going out and you're looking for deals and you're talking to investors, you can have your radar on in terms of what you can do with your self-directed IRA. All right, last but not least, we do have a rules and regulations section where we have the downloads, the diagrams. So if you're fearful of using a self-directed IRA because you hear of the sort of goblins and ghosts that are lurking in the shadows, We walk you through all of that so you can invest with confidence and know that you're not doing something that's a prohibited transaction. And then account types. So you're trying to select which account type makes the most sense for you. Roth, traditional, solo 401k. We have all the guidelines in there for you. So breaking it down for you quickly here, you get the virtual classroom training sessions, beginner to advanced. You get the Take 5 video series. You get our master transaction handbook. You'll get a physical copy, and then the digital download is in the course for you. So you can actually take that material and send it directly to your attorney so they have everything that they need to help you paper the transaction. That's what it was designed for. That's what it's used for. You get our investment processing manuals, equity trust client taught sessions, and then we have our bonuses, our case studies, rules, and self-directed account types. So 1985, this evening, we're going to offer this program at $997. So if you're someone that's interested in taking advantage of this, they are set up at the back table. They have order forms for you, so make sure you speak with them. And it's $997, which is a one-time fee, and you get access to the course. We do update this course on a consistent basis. Tomorrow morning, you will get an email, and you will have a link to create a username and password to log into the e-learning platform. This evening, you will take home a copy of the Master Transaction Handbook. All right, so you'll have a physical copy of this, and then digital copy will be in the actual e-learning platform. It is a downloadable PDF, so you can strip that out, strip pieces out, and send those to your private lenders, your attorney, CPA, or whoever else is helping you with the transaction. So that will conclude the official program this evening. I will hang out and take some questions, but what I would ask everybody to do, for those that are interested in taking advantage of the master course, is to get with the folks at the very back table. They have order forms. You can pay securely with a credit card. They will handle that, okay? So you're not paying me. You're going to go directly through the Real Estate Investor Association here, and they'll be able to set you up. But I will be getting you registered first thing tomorrow morning, so you get your link and you can get access to the course immediately. And I'll also mention that if you are someone that is interested in opening a self-directed IRA, with the course, we do offer a free one-on-one consultation. So you'll be able to spend half hour, 45 minutes, hour, however long you need, to actually talk through with myself or one of my IRA counselor colleagues. You'll be able to talk through your specific situation. If you're interested in establishing and funding an account, we will help you through that process. Don't feel like you're completely on your own. Because that's the key here, is to have the self-directed IRA, have the knowledge and education, and now you have the confidence to be able to go out and invest. So I will stop there. Anna, anything that, Chuck, anything that I missed that you want to conclude with? We good? All right, guys, so again, thank you so much for the opportunity here this evening. I hope you guys got a lot out of this. Was this good? Okay. All right, awesome. That's it. Thank you.